Hello and welcome to Credit Compass, your guide to navigating European credit markets. This week we're seeing a mix of stabilization and strain across Europe, shaped as much by global forces as by domestic developments. We'll start with the latest macro signals, growth, fiscal policy, and central banks, before turning to what they mean for credit fundamentals, valuations, and issuance. Along the way, I'll highlight key takeaways from our latest forward look for Europe and the UK, and what they suggest about where the European credit cycle stands as we head further into the year. All right, let's dig in. First up, France has finally got a budget. It's not exactly what was originally planned, but after surviving several no-confidence votes, Sébastien Lecornu has managed to get a budget through. The final package includes smaller spending cuts and more modest tax increases than initially proposed, but it can be viewed as a success in that it has secured political agreement. The budget implies a deficit of around 5% of GDP this year, well above the European Union's 3% limit, but with a target of returning to that threshold by 2029. With elections coming next year, we'll see how durable that path proves to be. On the positive side, the nominal budget deficit narrowed more than expected in 2025 and was the smallest deficit since the pandemic. Turning to growth, preliminary fourth quarter figures were released over the past week. They do not yet show a material improvement and in fact represent a slight decline from the third quarter. That said, there has been a modest shift in the composition of growth across the region. For the euro area, year-over-year growth came in at 1.3%, with the wider European Union at 1.4%. Not exactly anything to write home about. Countries that had been growing strongly, such as Ireland, Spain, and Portugal, continue to expand at a solid pace, but that momentum has clearly slowed. Spanish GDP growth is now 2.6%, down from over 3.5% in 2024. Portuguese growth has eased to 1.9% from 2.3% in the third quarter. At the same time, some of the countries we have been more concerned about are beginning to show upside surprises. French GDP growth was 1.1%, up from 0.9% last quarter, although slightly below expectations. In Germany, year-over-year growth came in at 0.4%. A modest upside surprise and an improvement from flat growth in the third quarter. Expectations are for further improvement in both France and Germany as we move into the first quarter of the year. The growth of these two large countries is important to support growth in the region. Germany in particular is the largest trade partner with the majority of European countries, and if it can start to improve its growth picture, the whole region should benefit. The spending plans by Merz's government will start to materialize substantially this year to help in that effort. Last week, we published our forward look for Europe and the UK. You can find the report, as well as a new video with Van and me discussing our respective markets at kbra.com/macrocredit. If you don't have time to read the full report, here's a quick summary. Broadly speaking, in our view, Europe enters 2026 with improving macro momentum and a cautiously constructive growth outlook. We expect tailwinds to gain traction through the year, with growth potentially surprising on the upside as monetary conditions remain accommodative and fiscal support increases. Low short-term interest rates, rising government spending, and strong private sector balance sheets are creating a more supportive environment for activity. Corporate investment is beginning to recover, particularly in productivity-enhancing areas such as AI and automation. Trade diversification, including potential agreements with Mercosur and India, adds incremental support. That said, growth remains uneven. France continues to face the political and fiscal uncertainty that we mentioned earlier, while Germany and the UK are showing clearer signs of stabilization and improvement. From a credit fundamentals perspective, conditions remain robust. Defaults and insolvencies are low, earnings expectations are improving, and leverage is rising only modestly, and largely for constructive reasons. Corporate borrowing growth has turned positive but remains well below prior cycle excesses. Interest coverage ratios remain healthy, reflecting the prevalence of fixed-rate funding secured at low costs. Sentiment, however, is uneven. Investor confidence, particularly in Germany, has rebounded sharply, while European consumer confidence remains subdued. That may be approaching an inflection point as real incomes stabilize and debt servicing costs ease. Inflation is currently under control and in some cases undershooting target, as highlighted by the latest French data, but we are beginning to see early warning signs. Notably, a sharp rebound in global commodity prices could reintroduce price pressures as growth strengthens. Despite these positives, valuations are tight and leave little margin for error. European investment grade and high-yield spreads are close to cyclical lows, reflecting strong demand for yield and benign default expectations, but offering limited compensation for downside risks. Equity markets are reinforcing this message. Valuations imply a meaningful recovery in earnings and confidence in a benign macro path, which leaves little room for disappointment. For credit investors, that asymmetry matters. When spreads are tight and equity markets are optimistic, credit tends to act as a helpful reflection of fundamentals which remain broadly sound. That environment puts a premium on issuer selection and balance sheet quality, rather than broad exposure. As a result, we expect episodic volatility, particularly driven by geopolitics and inflation surprises, even though fundamentals should ultimately prevail. Overall, Europe's credit cycle remains in a constructive phase entering 2026, but selectivity and a focus on underlying fundamentals are essential given the stretched valuations and elevated sensitivity to shocks. Turning to capital markets, debt issuance has been exceptionally strong at the start of this year. January has been the busiest on record for Europe, following a record-breaking year in 2025. And this strength is not limited to just Europe. According to Bloomberg, global syndicated issuance reached $1 trillion at the fastest pace on record, hitting that milestone 10 days earlier than last year. Governments have been the dominant issuers, accounting for around 40% of supply, while financial institutions make up roughly 35%. That's kind of typical for January, as bank and treasury desks look to take advantage of strong early year liquidity. But activity hasn't been limited to those sectors alone. Last week marked the busiest period for leveraged loan issuance in Europe, and euro-denominated bond issuance recorded its strongest January ever. The pace is unlikely to slow, with several large corporate deals in the pipeline. Funding for data centers and capital expenditure is expected to support issuance volumes over the coming months. This technical backdrop is likely to put pressure on spreads, particularly as investors become more fully allocated across sectors. Finally, we have two key rate decisions this week. Expectations are for both the European Central Bank and the Bank of England to hold rates. However, we anticipate another split vote at the Bank of England as competing economic signals continue to fuel debate within the MPC. So, let's bring this together. Positive signals point to a strong start to the year for Europe. Growth is beginning to turn the corner in the region's two largest economies, and we remain confident in the outlook for the year ahead. A final budget decision in France brings an end, at least for now, to recent political turmoil. German fiscal spending is beginning to flow and has already supported a notable improvement in investor sentiment. But what does this mean for markets? Well, issuers have been quick to take advantage of this momentum, but that activity could put near-term pressure on spreads as investors fill allocations and pause for breath. And of course, European markets do not operate in isolation. Recent movements in Japan have caused some volatility, and the conclusion to this week's election should provide further directional clarity. That's all for this week's edition of Credit Compass. Next week, we will look to cover a bit on company results and how they see European growth in 2026. If you found today's discussion insightful, please follow, rate, and share the show. It really does help others to discover it. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macrocredit. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass help guide your way.